So we missed an official correction of 10% by just a hair on last Friday, but since then the market's been in rally mode. So does this mean we're going to miss a big decline, a big correction like of over 15% that we saw over the last 2 years?
Well, I mean, given the headlines that we're seeing nowadays, it's hard to say. I mean, we have a bad event out of Greece or Europe, or who knows even what the Supreme Court's going to say about healthcare. There's just so many unknowns out there that you can't really say with definity what's going to happen. But so what we did is we looked back historically at corrections. On Monday, we actually did hit the 10% threshold before we rallied back throughout the day.
Okay.
And if you look historically, when you do hit that 10% threshold, the average decline of the market from that 10% threshold to the next rally is in the mid-single digits over a period of about 6 to 8 weeks. So not too much downside here, but what was interesting is there were 38 corrections from a 52-week high going back to 1928. And in 9 of the instances, the market bottom was the day of the correction or the day after. So there was, and the market rallied back, which is about 25% of the time. And in only 8 occurrences did the correction morph into a bear market before we saw a 10% rally. So the odds are actually greater that we may have seen the low Monday than that we're going to go into a bear market.
How about for June? We're about flat now. We were down 2% on Friday going into the month. Do you think we can see a positive return for the month?
History would say no. In the last 20 years, it's only been positive 35% of the time, which is the weakest of any month. Interestingly, last Friday, we had a 2.22% decline, and that was the same decline we saw on the first day of June last year. Last June, we saw to the 100th of a decimal. Last June, the market did rally back about 1% throughout the rest of the month. But again, we have Europe, we have this now economic cliff that we're seeing. Is it going to morph into an economic cliff or just a slowdown? And who knows? I mean, the Supreme Court healthcare decision, it just is a really big unknown, I think.
So it's going to be tough to rely on historical data, just given all the uncertainty.
Exactly.
So what are some of the stocks you're looking at in this type of environment?
All right, what we want to focus on for the long term is companies with more domestic exposure versus international exposure. Okay. And that would be the consumer discretionary sector, a couple names in there, Under Armour and VF Corp. Under Armour may have a weak day today after the Lululemon earnings. But if you can buy it on weakness there, that it's held up very well too. So if you can buy it on weakness, that's a name we like. Cintas in the industrial sector, uniforms, the employment picture is slowly, it isn't doing great, but the economy's doing better. Jobless claims had a little bit of a fall today. So that's, that should help the stock. And as the U.S. economy improves, which we think this weak data is more of a blip than a long-term trend, that Cintas should benefit.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to